the proxy season is now behind us. Obviously, one trend that kind of emerged was companies showed much more willingness to fight back against the activists. Why?
That's a great question. I think what happened in the last couple of years in corporate America is that institutional investors have woken up to the fact that many activist hedge funds are just Excel spreadsheet artists. They don't really always know better than the boards. And if you can demonstrate at the board that you are working hard, you are thoughtful, and the share price just doesn't reflect it yet, you will get the benefit of a doubt. I mean, what we saw this year is that in 70% of the cases, the boards actually prevailed in proxy contest, which means at the board, at least this year, you didn't have to be afraid of shareholder activism and shareholder democracy for that matter.
But what changed? Because traditionally, as I remember it, boards were very worried about doing anything that was sort of out there publicly fighting activists because of Reg FD. They didn't want to say anything that could materially affect the share price of the company. That seems to have died down a bit. Companies are much more willing to get on the front foot to, for want of a better word, diss the activists sort of off the bat. What shifted for that?
Well, look, I mean, if you think about it as a board, you have a choice. You can either just cave to an activist even though you believe they are wrong, or you can make your case. And in recent years, it oftentimes appeared as though you wouldn't have a chance with shareholders. Nowadays, you can actually make the case to shareholders and win in a proxy contest.
Another trend that we've seen is activists asking for slightly different things instead of wanting to take board seats themselves, often settling for an independent director. Why is that happening? What does that tell us about where we are in the market?
Yeah, that's a great question. What we have seen this year is that activists, for lack of a better word, have gone soft. And why is that? Activists are concerned about the economy. They're concerned that a recession might be around the corner. And other than the biggest activist hedge funds who can really weather a recession, most activists are concerned to get caught flat-footed if they are at a portfolio company on the board by the time the recession comes. Because if that happens,
they cannot. Liquid.
Exactly. They cannot cut and run. And
let's just end on the issue of size. We've seen a lot of very big companies targeted, obviously AT&T, Occidental, a number of others. It seems size is no longer a defense in itself. So which companies are safe from activists?
Well, the only companies who are really safe from activists are private companies. So for public companies, the activism is just the norm. Even companies with outstanding performance are oftentimes a target of a campaign. I mean, this year I defended one of the largest director battles in corporate America, a $7 billion company that had outperformed 99% of the S&P 500 and still ended up in a proxy contest.
Okay, so let's just look forward into 2020 and indeed 2021. What does the activist of sort of the year ahead look like?
Well, that's a very good question as well. Look, what we are going to see is that activists are going to be more cautious going forward. They're going to be more reluctant to launch proxy contests until it is clear where the economy is headed.
And the other thing we've seen, obviously, as part of this is directors being challenged much more for overboarding, the issue of directors appearing on too many corporate boards at once. Are we seeing the end of the, as it were, career director?
I think that's probably right. I mean, look, at the end of the day, being a board member is a part-time job, but there's only so many hours in any given day, and it's kind of hard to understand how anyone can be a terrific board member if you're on 6 or 7 boards at the same time.